Hey everyone, this is Stephen Orr, the CEO and founder of Quasar Markets, and I have a special guest today, my friend of many years now, Michael Litt. He's a global investment strategist. Look, y'all know him as the guy who wrote the paper for The Big Short at Front Point Partners. He brought to us about a year ago very prescient about how the markets were going to be over the next year, running straight up. And here we are again talking about his new paper. But before we do that, Michael, how are you today, man?
Good, good. We finally get to a day when rates are going to get cut,
I,
uh,
I love
which I
that.
think the world has been holding its breath for a very, very long time. And we'll even talk about the people who have been holding their breath the hardest today.
And let's talk about how we got here. You know, your last paper you wrote was a balance of uncertainties. You laid out a whole roadmap to show us exactly where the market was going to go, and you set it up. And look, here we are nearing all-time highs again. Let's talk about that a little bit. One thing I want to talk about first was the yield curve. I think it's finally corrected itself a little bit. You're looking at that from a perspective of the twos and tens, but you nailed that. So tell us a little bit about that.
Yeah, it's interesting that you bring that up. Balance of Uncertainties was published on November 2nd, which was the day after Powell used that term, a balance of uncertainties. And my read through, which market participants didn't actually get till the next Fed meeting in December, and I didn't understand why at the time, but I felt they had clearly signaled they had gone to a neutral policy stance at that moment. I felt that the pivot from hikes to neutral was going to be very powerful for risk assets.
Mm-hmm.
I thought that would impact credit spreads, or credit spreads would also continue to tighten. I remember in our conversation, I said that you should back the truck up and buy mortgages over 7%, because
Mm.
that was going to be a really, really good investment where you could earn a 10 to 12% return over the next year in a AAA asset. I liked beginning to shift to start thinking about the fact that the equal weighted S&P might become a better investment. I actually think it's probably flat on performance with the cap weighted, but if you start to notice it, the shift towards the other, there's actually 496 stocks, not 493, because the S&P has 503 right now. But the term 493, you're going to start to see better performance out of that in this next phase, which the direction of travel covers. It didn't hurt you to make that shift to the equal weight S&P or the smaller cap components of the S&P. Where we're really going to see outperformance as we get into the rate cuts is going to be in the mid, small, and eventually the emerging markets too. There's going to be, those are the assets that are cheap. People talk about the markets being expensive. Um, and in a direction of travel, I break down why a lot of the components of the market aren't that expensive. And we'll talk about some other reasons why the price for stocks may have shifted into a higher gear. Uh,
Hmm.
and we cover that in the piece. But um, what I think the time it took to get here, meaning there were 14 months between July of 23 and today, which was an unusually long period of time for rates to be at peak levels. Historically, I think the average was something like 7 or 8 months at peak levels, and sometimes the rate cuts come much faster than that. But this was an unusually long time at these rates, and
Yeah.
it put pressure on businesses that have to borrow money at floating rates, and those are small, medium enterprises.
And you talked about that from the perspective of emerging markets, and you also nailed China, China, China. China stocks fell out of bed, and here we are. You were totally right. Is it just because of geopolitical, or is it other things too?
Well, I think that the geopolitical, the mistakes with the wolf warrior policy, where their ambassadors were aggressive rather than ambassadorial, um, aggressiveness in the sea off the Philippine coast, which they've continued to do. 60 Minutes did a nice piece on that the other night. Their aggressiveness with respect to Taiwan um, has really accelerated the offshoring from China. Biggest beneficiaries are places like Vietnam, Mexico, and the United States.
Hmm.
Um, the fifth plenum was a complete disappointment. They didn't do anything. I felt that they were this real estate. I mean, you always think back on what was I thinking at the time when I made the China call on, sell China, or if you own own EMX China. It's, I thought the real estate situation there was going to take much longer to get sorted out, and it was going to have a bigger impact on the economy over there. It has, and there have been complicating factors. Youth unemployment is now, probably over 30%. They've
Yeah.
stopped. This is another problem. They've stopped publishing economic data. So nobody can get a read on what's actually going on. We don't have a good handle on what GDP is. They have a saying in China, the sky is high and the emperor is far away. So say whatever you want, or do whatever you want. It's an old
Right.
Chinese saying, but China has some structural issues, which I talk about. I talked about extensively in uh, the balance of uncertainties, and I cover again here in the direction of travel. The big question you have is what is the transmission mechanism, and what is the multiplier of a percent loss of GDP in China has what impact on the US? Well, it's about 0.15.
Mm. So very.
Whereas Europe, it's more like 0.3. A little more impact on Europe. Japan and Australia closer have a higher gearing to weakness in China. Now, Southeast Asia is hard to read through because they're benefiting from the offshoring, while it does negatively impact, slower growth in China does negatively impact. So there's a cross current there. It's difficult to predict. China has not solved its problems. Its structural issues appear to be well entrenched. There will be rallies in Chinese stocks. Those are trading rallies. I think those are very difficult for investors to play. It's not your highest and best use of
Right.
capital in the international markets. But when we start cutting rates and the dollar begins to weaken, because we've had a very strong dollar for a very long time, you will start to see flows of capital into European, other international developed stocks and into emerging markets. The first place that's going to see it on an accelerated basis is going to be the mid cap and small cap in the US. And what you're going to have is 10 pounds of mega cap proceeds trying to be shoved into a 5-pound mid cap and small cap bag. And that is going to send prices and valuations quite a bit higher over the next 6 to 12 months.
Let's talk about that. You have just written the paper, The Direction of Travel. And look, I recommend literally anyone listening right now. We're going to give you a free copy of it. Michael Litt's been so gracious about this, about giving his thoughts out there. So we thank him for that. If you need a copy of it, you can either download it. We'll get it to you. Don't worry about that. But let's talk about that. It is Fed Day here. And let's talk about Federal Reserve policy. You have in the past spoken very highly of Fed Chair Powell, and you said that we should all be grateful to have him. And let's talk about that. Now, Powell has said for the last, as long as he's been here, he wants to get down to 2%. We're not quite at 2%, but we're almost at that point, and I think today we're going to cut, right? Let's talk about that. I want to know about the strategy, what you think he's going to do. I also want to talk about the economic growth that's going to come out of this, and then let's talk about some of that puppet move that you've been talking about, the play there.
We first of all, I do very much, and I reiterated this 2 years ago, and I reiterated it a year ago. I do think Powell has done a very good job. One of the things he touched on in his speech at Jackson Hole, which was the reason that inflation stayed high for longer. And it had to do, and it was, he disclosed something that he hadn't before, which was he and Congress were concerned about the 10-year recovery this country had to go through
Yeah.
after the great financial crisis. Do you remember how long it took for labor and real wages to come back? It was a slow, torturous decade. And it's actually in that decade that the worker fell behind, where affordability became an issue for him, for us, for all of us, and that the price shock from the supply side issues of COVID really drove that home. That didn't
Hmm.
happen during the recent administration. That happened because of GFC and the 10 years of low to negative real wage gains.
Yeah.
Um, and I think the reason that they made a decision that they were going to stimulate with the CARES Act and the spending, the checks we all received in the mail, and that they were going to experience inflation, but and then they would manage the inflation with uh, interest rate policy. That, call it 2.5 year period, right, which we've now come to essentially where inflationary expectations are now anchored in somewhere between 2 and 2.5%,
Right.
which is going to bring down the cost of funding the deficit down. It's going to bring the cost of borrowing money for small and medium enterprises down, all of that. But this was the trade off that they made for instead of having 10 years of slow worker return to work wage gains, right? So you pick your poison. Do you want to spend 10 years with workers getting below real wage gains and having unemployment only slowly crawling back out of a bomb crater? Or would you trade that for the 2.5 years of inflation and having to manage it down? That's the decision they made. And he made that very clear. Now, we have seen on the political horizon the possible threat of replacing Paul with either a puppet or worse, having the White House approve or get its fingers into interest rate policy. Now, the last time we saw that was in the 60s and 70s, culminating in the Arthur Burns Fed, when we had persistent inflation and inflation expectations that were getting towards 10% and baked in the pie.
So let me make sure that everybody understands. We're talking about the Fed right now is independent of
Right.
political pressures. And you're talking about Arthur Burns, who is pretty much bending to political pressures. Um, are you saying that you're saying, depending on who wins the White House, that there might be some bend to political pressure here?
There has been an explicit document published about not liking Powell, removing Powell, having the White House be involved in interest rate decisions. That would result in everything else I'm going to say, take it off the table. You're talking about a 25 to 35% bear market.
Mm.
We're talking about an absolute disaster for risk assets,
Right.
private equity. I don't care what it is, all risk assets. You cannot go back to a either a puppet running the Fed who has no central bank experience and political ties, or the White House or Congress involved in what the Fed does. Central banking is not a perfect operation, okay? Central bankers often get their projections wrong, but this is what happens in countries like Venezuela or Argentina or Zimbabwe is this, where the government is running the central bank.
Yeah.
People who have no central banking experience. Okay. Baseball pitchers have bad days. They get shelled. So do central bankers. They have a couple of years where they don't get things exactly right, but they do try to get things right. Your alternative is an Argentina, where you have inflation that's so high that right now that it starts to look like the Weimar Republic, where people are running around with wheelbarrows full of cash. So that is a massive risk. People should not take that issue lightly. It is a very dangerous situation. And I speak as a global investment strategist. I never get involved in politics, Stephen. You know me. I never talk about politics because it only clouds your views of markets and
That's right.
value and medium and long term objectives. But this one, I will tell you, if we go back to that, we have some real problems. Now, um, labor market, the unemployment that we have seen is largely because we're seeing people responding to these higher real wages that the workers are now getting. It will take us a few years of these real wage gains, 2 to 2.5% real wage gains, for the workers to catch up on affordability. But with inflationary expectations tied to 2 to 2.5%, if we keep getting productivity gains, then real wages will come. And by the end of this decade, that affordability issue can be addressed. But you can't address that issue immediately. It was
And
created from 2010 to 2020, and it's now we're in a position where it's being solved, but it won't be solved in 1 year. It gets solved over, the balance of this decade is what I would say.
and we're seeing consumer confidence really pretty high considering. But if real wages aren't keeping up with inflation, is that part of what's going on with the malaise in the market? And when people are unhappy, are they just saying they can't afford gas and chocolate and all the fun things that they want? Or are they just not getting the right job that they want? It seems to be that this softening in the labor market seems to be some outsized position here from somewhere else, not maybe not just from workers not fulfilling their positions.
I think that
Affordability.
affordability issue, and it's real. I mean, the supply side elevated prices of things, some of which have come down, like timber, some of which, like cement, has not. Appliances went up but haven't come down, right? So I think that is real, that affordability issue. But again, that was created after GFC.
Right.
It's it's misplaced to try to say, oh, that happened between 2020 and 2024. It didn't actually. It's a real issue, and I think there also is, whenever you have in a dynamic um, capitalist system, you have change, right? And people need new skill sets to get jobs. Um, I actually think that people with skill sets can now live in. I'm going to a wedding this weekend in Carterville, Illinois, and the um, the the groom is an engineering major who lives in a small town in rural Illinois, but works for a Silicon Valley company and a very high paying job. That wasn't possible before.
Right.
I think that's a wonderful diaspora for this. And let's put up the chart about the condition of the household financially here. A very important point that, can we get that big? Um, let's see. How do we get that? How do we get?
They'll see it big on the YouTube. Not a problem there.
Okay. So what's happened is the household's debt service burden has dropped to its lowest level. And so the household's debt service is actually extremely low. The balance sheet is positioned to grow. And if you look back, I point out in the direction of travel the two cycles in 82 and 95, where they started expanding their balance sheet and taking on more debt service, right?
So explain debt service. Does this mean they're buying more homes? Is this they're going credit card debt? Are they buying better cars? What are they doing here in the debt service?
Right. So what's happened is they haven't bought a lot of houses. And that's one of the reasons they don't have a lot of debt service. They've also kept their cars longer.
Mm-hmm.
They're keeping their appliances and their cars longer, durable goods, right? What happens in the 82 expansion and the 95 expansion, by the way, those were the beginnings of huge bull markets, huge, enormous, I'm talking 3, 4, 5x
So what
moves.
you're saying is they've kept these appliances, these cars, durable goods longer,
Haven't bought as many homes.
and now it's time to buy the home. It's now time to buy the new refrigerator.
This rate cut cycle, right, is now going to kick off more consumer confidence, not only for buying, going out to eat or seeing a movie or going to uh, I would say a Taylor Swift concert, but I'm going to say a Chris Stapleton concert, right? Chris Stapleton concert. I love Chris Stapleton. So it's not just that discretionary spending. I think you're going to get to where they're going to start to buy homes at these lower mortgage rates because it's all relative, right? They look at their monthly payments. All of a sudden, once you get into the 4% mortgage rate, home sales, home building, all that's going to take off. I talk about that in the paper.
Yeah.
Those purchases, that household formation activity is huge because then there's all these durable goods purchases that follow on, right? Redecorating, new appliances, maybe another car because you're living, you have a 2-car garage. All of that durable goods purchases follow on.
What about computers and software and businesses buying as well? Is this also translating into that too as well?
Let's go to that. Hold that thought, Stephen. Don't let me get off the hook on that one. What these bull markets did from this position of having very manageable, and what that chart shows is debt service as a percentage of income. It's only 9% right now, and in the past it's been 13, 14%. So
Right.
it's very low. So there's plenty of room for the people to purchase, the households in the US to purchase homes, to expand their balance sheet, to get this durable goods cycle going, right? That will perpetuate something that's already been going on in the US, which is the continued increase in profit margins. We have gone from 5% profit margins back when that bull market started in 82 to 13% profit margins for the S&P 500 companies.
Right.
This cycle will continue to power that profit margin higher. This is what I point out in the paper is that CAPE, that CAPE, which says the market's overvalued. CAPE will tell you that stocks were attractive in 1988, 1993, 1982, because the profit margins were so low and the multiples were lower. What I lay out in the paper is the rationale for the fact that for every dollar of revenue, the S&P 500 companies now have 13 cents of profit margin versus 5 cents. You will own stocks at higher multiples because of that. And there's a compounding effect to that earnings growth when you're taking out that much more slice of profit. So one argument in this piece, which is important, is the structural shift. And like CAPE is like a telescope looking backwards, right? It will tell you that you wanted to own stocks when profit margins were 5%, not 13%. That's what it misses. It misses that the asset, its efficiency, and its ability to compound profits and free cash flow and wealth and be more capital efficient, it misses all of that compositional factor. Does that make sense?
Yeah. And I mean, when you look at it from that perspective, I also have to ask the question that the savings rate of the average person right now is the lowest it's been probably ever. During COVID, it was the highest pretty much ever. Some of that money is going away too, though. Are they putting that money away and also buying that durable goods in the future? Or are they, I mean, to me, it's a little bit of a disconnect there because I feel like people are not saving. They're still spending it. They are going to those Taylor Swift concerts. They are doing those things. And there might not be just enough money for that new Whirlpool refrigerator that's on the fritz right now.
Well, let's look at the next chart here from the Fed, which is I think the next chart has to do with, yeah. So right now, that's the money market assets. And if you look at bank CDs plus money markets, you're at $9 trillion. As a percentage of the market cap of the S&P 500, that's 19%. It's never been that high.
Never been that high, no. Correct.
You've never had this much cash to the value of the.
including Warren Buffett. I mean, he's got so much on the sideline. That's what I've
Yeah.
been saying. The market seems to be undervalued because of just the sheer amount of money on the sidelines. But it has to go somewhere, and not necessarily in the stock market, right?
I think, look, the conclusion of what I just said is you probably, if you can buy the market or 15, 16, 17 times earnings, that's going to be deep value. The market may trade up to 22, 23, 24 times earnings at times, right?
So another 30% run in the market. Is that what you're saying?
What I'm saying is that I think you made more money in the neutral after a balance of uncertainties initially. I think the markets will be constructive, okay? Especially if you own the undervalued assets, not the mega cap S&P cap weighted. Don't market to that. Market to how you're doing in your mid cap growth, your small cap value, eventually your emerging markets and your non-US dollar, right? I think you'll do better there. But if this confidence in home building and this balance sheet expansion starts to occur, right? I think that 2025 into 26 could be even a better year. And I think you'll start to see some good things happening in private equity. I think as the cost of capital comes down, you'll see that. I think secondaries in private equity are going to be a really good opportunity. Especially some people aren't getting any exit capital flow back from the private equity. There are opportunities in secondaries for continuation funds and other liquidation events on single names. There's going to be some very unique, different opportunities, but I think I'm not going to go overboard about bullishness right from here over the next 12 months. What I really like, though, is if the cycle gets going, when interest rates are down, inflation's anchored, people see that they're getting another 2.5% wage increase in 24, in 25, maybe in 26, right? You get that cycle going, because that was a decadal cycle. It's a decade-long cycle in 82 and again in 95. Those drove big, hairy bull markets, Stephen. We just finished, and remember when the sentiment bottomed in October of 22, it was the most bearish since the Iraq invasion of Kuwait and 2009. And I said, this is the beginning of a bull market. We've only finished the first phase of a long bull market, right?
Yeah, but when you talk about the 80s, I can harken back to say 87. When you talk about the 90s, I can talk about .com. They always ended in a massive crash. Is that what we're looking at right now? A nice long run and then another crash?
No, we have not with that much money market cash, not with everybody full employed, not with real wage gains, not with economic growth probably vacillating between 2% to 2.4% in the coming 12 months, only because there's a lagged effect of 14 months of peak rates.
And right? You're not seeing any cracks in the economy at all?
I see the economy actually starting to reaccelerate.
Okay.
Starting to reaccelerate. I think that the Atlanta nowcast will probably shift from about 2.4 up to 2.6, 2.7 before the holidays. Right? I think the consumer is going to feel very good as interest rates start to drop. Now, these people with $7 trillion in money market funds are going to start to earn a little bit less. But you know what's going to happen to that money? Invariably, when it gets down to 3%, yes, it's going to go into risk assets. And that's when this, again, it's not only the, reallocating out of the mega caps, it's money market. I have a veterinarian friend who's perfect. He won't invest in stocks when I tell him we're at the bottom. And then when his money market gets to 2.25, he's going to ask me what stocks to buy.
Right.
He's like the doctor and the dentist.
Right.
This happens to be a vet, but they haven't even gotten involved yet.
Right.
They're still sitting there looking at their money market statement, happy to earn a little bit, 5.25% every. I mean, they literally are. There's like I used to call my dad a CD high roller, right?
That's
And
always,
he'd get mad when interest rates were low, right? And then they eventually, when the rates are really way down, they ask you, okay, now it's time to get, you know, into risk assets. They haven't even gotten involved. When they get involved, and you get some
the acceleration will
excess like
happen then.
cryptocurrencies
Yeah.
again, right? Or cannabis or sports gambling companies trading at $5 trillion, then I'll tell you you're at that point. But you haven't even made the transition to the next phase of the bull market. Are there corrections? Are there even 20% quote bear markets within long bulls? Yes.
Yeah.
We've already had a few, right?
But you're saying there's no cracks in the economy. Let me push back on you on your own words. What about gold and China and pulling out of treasuries? I mean, to me, when treasuries coming out, somebody's got to replace that money. And now I know the U.S. citizens are the biggest buyer of U.S. treasuries, obviously, the Social Security and other ways. But you're seeing some macro global issues here when you see massive companies like Japan and China and pulling out of U.S. treasuries at the highest rate probably in history.
Um, yeah, and if we don't have an independent Fed, Katie, bar the door, Stephen.
Okay, so there's the crack that you're concerned about, correct?
That would be, yeah. There is, a few months ago, the probability of that happening looked. It doesn't look quite as certain now, but it looked pretty. Like, okay, I'm not sure I want that. But as far as gold goes, I've been reasonably. I'm not a gold person, but
Right.
People are trying to get their money out of China. And China is legitimate. People don't know this. The Chinese central bank has very low gold holdings relative to its total assets.
Is that why they're buying?
Yes, they're actually trying to get up to other developed market economy gold ownership levels. So they're adding to their stock of gold from a
But
structure.
they would not think of themselves as a third world country. They think of themselves as a first world country. So are you saying they're trying to get up to our level status of owning gold or Russia's level of owning gold?
I do think the $300 billion that got locked up when Russia invaded Ukraine was an eye opener for China. So I think that is consideration. China's economy is doing much worse than advertised. I think that's why they don't publish data. They talk about a 5% growth rate. It's not there. They're somewhere between 0 and 3% growth, Stephen.
Hmm.
And the local governments haven't been able to sell land because of the real estate downturn. So now they've gone from self-funding to needing the central government to provide them funding because the central government does not want them raising taxes, which would only compound the growth issues they're having,
Right.
right? So this is why they have real structural problems. But their accumulation, and I mean, there are actually, in the third quarter, there will actually be net capital outflows from China for the first time in, I don't know how long, since
Right.
maybe the 80s.
I mean, even Ray Dalio said this morning that he's still got some money there, but most of his money is already pulled out of China. He was concerned about China.
Yeah, well, Ray's a smart guy, Front Point and Bridgewater used to go head to head. We used to compete. We were the two institutional hedge funds back in the day. And I see him at New Canaan getting coffee at Zoombox. He and I
All
get
right.
coffee.
Yeah.
We both like the same coffee joint, so we run into each other there. Um, and it's not just so China has a structural reason getting more gold into its central bank. It actually could keep doing that, but they don't have as much excess uh, monetary holdings as they used to. So that they're selling treasuries is because if you're spending your wealth down, they're in a wealth spend down to
Right.
some degree. They are also shifting from treasuries to gold. I think the Russia-Ukraine thing did have an impact. That's why I was constructive on gold. You can still be. The only problem is the gold bugs are all banking on a single buyer, and that's China.
Yeah.
And I feel the trade has gotten long in the tooth. When you are waiting for a single buyer like the Hunts with silver back in the 70s, it never goes well. And then silver crashed. It's never seen that price ever again.
Right.
I'm not saying gold's going to crash.
Even though we're at $31 an ounce in silver today.
Huh?
Even though we're at $31 an
I
ounce
think
in
it was
silver.
what, 55
50,
something?
yeah.
50 something. Whenever you're relying on a single buyer and that's your investment thesis, that's when Bernard Baruch and I
Right.
will sell.
Right.
I still, the Chinese will still, this, like, and Russia too, because Russia's got even bigger economic problems on the backside of this foolish, I call this Putin-esque blunder of invading the Ukraine.
Right.
Because they've isolated themselves from all of Europe. They could have been part of the European community, and now what they've done is they've made themselves, the people you have to protect yourselves from.
Right.
And I don't think there's, other than, Hungary, and maybe Moldova, you don't have many friends over there in Europe.
Right.
So in terms of the global crisis, I don't really see that. Global growth has been slower than the U.S. Okay, and it looks like global growth may be bottoming. There were a lot of things like the energy. Europe got hit really hard with the energy prices after the Russian invasion, right on the back of COVID. And I'm wondering if we aren't going to see a stronger than expected recovery in Europe coming out of the US dollars. And remember, the most important thing for emerging market equities is a weaker dollar. Because when dollars are freely flowing, that really helps emerging market economies. And we've had a tight dollar condition for a very long period of time. So there's a lot of pent up potential there, both growth in Europe to surprise on the upside and a freer dollar that's going to eventually really push EM higher. Again, mid and small cap US first, possibly Europe, developed markets, and then after that, the emerging markets. Australia and Japan are going to suffer more, as we talked about earlier, because the transmission mechanism is stronger from China into there.
So give me that soundbite here, Michael. What's going to drive us into a Goldilocks economy?
The Goldilocks economy. So if we look at the next slide that we have here, we really will potentially have the situation where you get these real wage gains and you get the onshoring, so you get some productivity growth. Stephen, can we grab that other slide? Yeah. And this one I need to, this is the, privately, right. This is our, and you can see how far down home building went after GFC, the big recession bar, the big gray bar, and how slowly it came back. We really only got back to normalized building levels just around COVID, and then they had to finish the units, so there's a lag, so it kept going up. Now it's come back down. I think it's the turnaround in that. I think it's the turnaround in that some of that $7 trillion starts to go not back into the market, but back into household formation. That the Gen Zs and the millennials kind of simultaneously start pursuing household formation, durable goods purchases.
I agree.
They're getting real wage gains, and you start to look at a 1982 and 1995 scenario again. And it was in those two periods that the term Goldilocks economy got. And you will get to a point where the small and medium enterprise businesses in the United States who borrow at floating rate, who represent 80% of employment, Steve.
Yeah, it's true.
They start to show expansion intentions, and their employees feel confident to go out and buy a house, right? And the Fed anchoring at 2% starts to make, 4% more, maybe a 3.75% mortgage. You might see that in
And
20.
I'm hearing that everywhere. Everybody wants to buy a house that doesn't have a house. They want a house. They're excited about buying a house.
Well, and the thing I made the point in the direction of travel, I make the point. You've also got people who want to sell their house but don't want to move because they want to wait till they can sell their house and get a mortgage rate that's at least only 1% higher than their old
And
mortgage.
they can't even find a house right now if they can.
Well, but the point is that it's not just the home builders who could put supply in the market. It's these rate sensitive owners of pre-existing homes who want to sell,
Right.
but they want it, when the rate gets to 4%, below 5% on a mortgage, they will. And by the way, our 7% mortgages we bought the last time we talked, guess how well we did on our investment when those mortgages were at 4, right? So that
Pretty much.
investment's still going to work for another 6 to 12 months. So that will have been a very good investment for a 2-year period in a AAA asset. Um, and there's some really good ETFs I found recently, um, that have really make it accessible for people to invest in mortgages. I think one group's called Simplify,
Hmm.
Simplicity. They have a couple. I bought one of their products called TUA, TUA, which was a 5-time levered 2-year. I bought that
Hmm.
back in June. It's just absolutely crushed it because the 2-year is now, as you say, reversed, right?
Right.
And people ask the question, why did the 2's 10 inversion not predict the recession, right?
So, Michael, I just want to say one more thing. Thank you so much for being a part of my life as a friend, and I'm looking forward to many, many, many of these moments with you because I believe in your knowledge of over the years, and so I look forward to seeing you next time.
Stephen, thank you, and good luck investing, everyone.